Our next guest is the author of a best-selling book, Digital Bank. A review on Amazon calls it the best book about banks you will ever read. He's worked closely to big banks like Societe Generale, the HSBC, and is the chairman of the Financial Services Club. And he's going to give us some digital bank insights. Proudly brought to you by TSB. Please welcome Chris Skinner.
Thank you, Nadine, and good morning, or good evening, wherever I am. You can tell from my accent I'm a bit of a foreigner, so I hope you can understand what I'm going to say. I'll try and speak a little bit slowly, but I've got a lot to cover because I'm shamelessly plugging my book, Digital Bank. And that's 400 pages, and so I'm going to try and get through as much of that as possible in the next 35 minutes or so. As Nadine mentioned, I run a thing called the Financial Services Club. I was made redundant in 2002, having worked for technology companies all my life. And I thought, what shall I do? So I began by just starting a hobby of drinking with bankers. And it's kind of become my business, so that's what I do across Europe. We're in 8 countries, and we meet in the evenings talking about the future of financial services and drinking a lot. I also blog every day. I'm a bit of a nerd in that respect. I've blogged every single day since 2007, February the 1st. And in fact, before that, I was writing a lot of stuff which became books. So I've written 11 books. Digital Bank is the 11th one. The others are really boring. They're about regulation and directives and investment banking and all sorts of other things. But I cover all that space because I deal with a lot of people across all of the world at conferences like this one. And I'm thrilled to be at this one because I've only been to New Zealand once before, and I only had a day here, which is not long enough. So I had a couple of days to spend here really absorbing a little bit of the culture, which I think is a really wonderful culture because it's very laid back, but at the same time very engaging. I haven't discovered anyone who's yet got angry with me, which is quite unusual, but by the end of this session I may have changed your opinions. And yesterday I was standing on top of a live volcano, which is the White Island, just by Rotorua. And I kind of felt that was a little bit like the industry we sit in today, because it's like a live volcano. You're waiting for it to erupt or disrupt. So I was going to use my holiday snaps to share with you, and then I thought that's a bit narcissistic, so I dropped them. Talking of being self-centered, suffice to say, this is the hot space. Digital is the hot space, and that's the reason I think the book's doing well. People tell me that it's a book that they put alongside Brett King's Bank 2.0, now 3.0, but the difference is that that book is pretty much someone who's outside the industry looking in to where the industry should go, whereas people tell me this book's more like someone from inside the industry looking out to the future about where the industry should move to. You can make your own minds up. I'll be interested in your opinions and views. But it resulted, because of all the time I spent talking about technology and all the different areas of banking in the future with technology, in 4 presentations that I deliver, about 1,000 slides worth, which I'm going to share with you today. So I'm going to speak for 3 days. No. I do a lot of culling of all of this stuff to make sure it's to the point. And I was trying to work out which one to share with you, and I thought, well, I'll share with you why you need to be a digital bank or a digital financial institution. It's more to the point. And really this is because a lot of people now are getting through the things that are stopping them becoming a digital financial institution, the barriers to their mental brain of not seeing social or mobile as important. I think from Richard and Simon's presentations, you saw everybody knows that mobile, social, and technology and cloud and all the changes that we're going through are important. But does the management team understand what it really means to the institution? Can they really buy into it? Can they commit? And that's when normally people bring me in because I make them commit, or try to. Mainly because, as you heard from Simon, most of the institutions that I deal with were built in the last century for the physical distribution of paper through a localized network that was bricks and mortar. And now we're all being challenged by this digital distribution of data through a globalized network. What does that mean? How do we become a globalized data store and a data value exchange? What is all that going to mean to our structures and our thinking? And I think the result of all of that is that there's 3 things that are going to happen. First, there has to be a new business model for the institution. Then there has to be a new architecture that's digital. And then there has to be a new organizational structure that's sitting on top of that architecture that's human and engaging. And really that means that from the architecture you need to move from physical to digital, from the business model, it needs to be a digital business model rather than a physical one. The architecture needs to be focused on access to that digital core rather than channel-based. And the organization needs to be customer-centric, not product-focused and silos. Old banks, old financial institutions push products through channels to customers. Digital institutions build communities that access their digital structures and engage. And that's the new business model architecture and organizational structure that you have to build to be digital. Now, most financial institutions, I find, have a business model that's based around three pieces. First of all, they provide products, so they manufacture a product or service, and that's the back office. In the middle office, there's lots of processing that takes place to get those products to market, and that's the infrastructure that we put in place in the last century to process payments. And then we have the customer intimacy at the front end, the retailing of the products and services that's meant to be really nice and have intimate knowledge of the customer and their relationship with the institution. That's like three businesses, three separate companies in one umbrella. Then we have lots of pieces of banks and financial institutions that cover the different products and services in lines of business, in retail banking, private, wealth management banking, commercial, transaction banking, investment banking, and insurance. You start to see this is getting into a bit of a complex model, particularly when last decade we had a few banks that had global ambitions. These banks felt they should be global, universal banks that provided all these products and services to all these people across all these manufacturing, processing, and retailing experiences. And to be honest, that's a completely broken model. That's a model of the last decade, last century. You cannot be good at all things to all people. And I really don't like the fact that some people think they can be, because they can't. And in fact, this is being broken apart, not just because the model's broken, but because the technology is breaking it apart, as well as the regulations. If you look at Citigroup, for example, they had over 100 countries of operation in 2007. Today they have 71. HSBC had 85. They've now got 74. These banks are retrenching from a global universal banking model to be much smaller and much more focused. Being good at where they're good at, and then bringing in partners where they're not. And in fact, one of the things about the technology is that the retailing side, you see the mobile apps and social making a radical difference to the engagement and the intimacy in the relationship. You see in the middle, the processing being fundamentally changed because we're now being real-time focused through APIs, application program interfaces. And in the back office, the product is actually being completely reinvented through data leverage in the cloud. And again, you heard some of that reference by Simon and Richard in the first two presentations. But I think it goes further than this, because what I see happening is lots of little insects buzzing around these large gorillas and saying, we can be really good at this stuff and break their model. And they're doing it. One of those insects is Zopa. Zopa is a company that presented at the Financial Services Club in London when they were just about to launch, 1st of March 2005. Now they've been copied everywhere around the world. There are many, many, many peer-to-peer lenders. And that's effectively what they do. They provide a lending platform to bring those who have money together with those who need money and remove the middleman. Historically, the middleman has been the bank. So when you want a loan, you take those who have money, they give you deposits, you built an organization that was physical for the distribution of paper in a localized network, and got that to people who needed money, the people who wanted loans. Zopa just say, don't need anything in the middle, except technology. And this is the core thing for me, which is that every insect that's buzzing around our industry is saying the middleman, the trusted third-party intermediary, is no longer relevant in the new technology world, in the digital world. It's a platform. In code, we trust. Zopa started in 1st of March 2005, and a lot of people didn't get that they were an eBay for loans, bringing those who have money together with those who need money and a much narrower basis point differential. Now they've managed loans on their platform to £500 million worth of lending. They're not a lender, they provide the platform for lending. That's why they're not regulated as a lender. And now there's lots of others that do the same thing. In fact, the Lending Club in the USA is just doing an IPO for $5 billion. That's about the same amount of lending that they've enabled through their platform, $5 billion worth. And Prosper's also delivered quite a strong service in America. And it's not just in the retail banking product back office space for lending that we've seen that change. We've seen it in business and commercial banking. I've been amazed by the growth of Funding Circle, which is a UK-based company again, that started with the same idea as Zopa, but for crowdfunding for business. And they've grown very rapidly in the 5 years that they've been around, such that they've now enabled, and this is from about 3 weeks ago, this has gone up to 415 million this morning, but 3 weeks ago it's 395 million pounds worth of loans funded by 33,400 people to 5,500 businesses. It's focused on small business lending. What stuns me about that is that when I did that presentation 6 months ago, that figure was 225 million pounds. This is doubling in 6 months. It's government-endorsed lending because the government sees a problem in the UK with getting money to small businesses, which is the fuel for the economy in the future, because the banks have tightened up all their lending. So alternative finance, finding money from someone that's not a bank, is becoming the norm rather than the exception. And that's going to be a big change in the way that everyone thinks about funding alternative finance and the old financial system that's built for the physical distribution in the last century. For example, 77% of the Funding Circle users say they're likely or very likely to use the peer-to-peer lender first in the future rather than even talking to a bank, because it's so much easier. So crowdfunding, peer-to-peer lending, is really shaking up the whole industry for money. And there's lots and lots of insects here, and I could talk about them around the world, Buba, Smava, PPDI, I've mentioned Prosper, Lending Club and others. But the gist of that marketplace is, the latest estimate I've got from the analyst company is that this is going to be worth around $1 trillion 10 years from now in lending through the platform rather than the trusted third party. So I could talk about all of these areas, and normally I would, but I'm going to limit it to focusing really on payments and transaction banking, because that's what the folks are in this room, I hope. Start with a couple of examples in payments that I see big changes, particularly in commercial banking, for example, in the FX processing across the world. This is a currency processor that's cloud-based, called Currency Cloud. Very imaginative name. They started just 2 years ago, but are processing $600 plus every month right now. So $8 billion a year in 2 years from a company that just says, we can do remittances, FX, and exchange for banks, counterparties, and companies through the cloud. It's far cheaper and easier. And they're being very successful at doing that, growing really quickly. They just did a deal with xe.com. If you don't know xe.com, it's the website for finding out about exchange rates. It's one of the top 400 websites in the world. And that's big news, because every time that someone looks at xe.com for the exchange rate, they'll see that Currency Cloud can do it for them really cheaply in the new partnership. They're going to grow brilliantly. TraxPay is a fairly new company, again, in commercial markets that's providing the procure-to-pay cycle for corporates in a real-time, transparent, seamless window that's really easy to use. So you can look at all your receivables and payables really easily. And the information enrichment that TraxPay provides around all of that is quite incredible. It's the reason why MasterCard's just selected them for providing their supply chain services in a new partnership. A company that's just sealed a $15 million investment in their Series B funding round. They're doing payments changes in terms of information enrichment, data leverage around the payment is what's going to be good for the retail intimate distribution of the service. Customers want that. That's where the customer relationship will be, going back to the earlier question. But it won't be owned by TraxPay. The customer owns the relationship. The processing is different because it's cloud-based processing. And I know that you talked about Apple Pay a lot yesterday. I don't know what was said. To me, it's not that interesting. You know why? Mainly because Apple's a Goliath. I mean, it is massive, 800 million active accounts, as referenced in Richard's presentation. In Simon's presentation. But it's not changing anything. It's changing the customer and the way they pay, but the payment mechanism underlying Apple Pay is the same old payment mechanisms. And in fact, what intrigues me is that the banks are actually buying into Apple to be in the network. That's what the real change is here, that banks are discounting their transaction fee rates to be in the wallet. If you're not cheaper, you're not in the wallet. If you don't comply with Apple's policies, you're not in the wallet. That's the only thing that really intrigues me about the Apple Pay thing. But it's not fundamentally changed the system. Although it does get interesting when you see Indiegogo, which is a crowdfunding site, integrating the app with Apple Pay so you can do crowdfunding just with one click. You don't have to even have to think about it. All the friction is removed. That's the point. Again, what Simon's saying about Uber. The friction removal is the focus in the customer relationship. And the friction removal can be achieved through processing with APIs, through the cloud with better data knowledge about the customer. That's where all the change is coming through. When we see Square, that's a retail change at the end game. And when you see something copied, you know it's good. So I mentioned Zopa, copied around the world by many, many companies. Square's been copied around the world by many, many companies. Pay11, Empower, SumUp, iZettle, many. And some of them are doing quite well, but they're all going to be wiped out by PayPal. In fact, Square's already stumbling and struggling because they haven't innovated since they did Square. They did the dongle, they did the wallet, they did a couple of interesting things around apps, but then they haven't really done much since. So I think they'll disappear thanks to Visa and MasterCard and PayPal. I recently got PayPal here. And if you don't know what PayPal here is, it's their version of Square. And I got a chip and pin terminal. It was £49, 100 New Zealand dollars. And the reason I got it is I just done the book launch. It was just coming up. And I wanted people to pay to buy my book, because I'm really mean. So I took chip and pin payments at the book launch. Stick it in there. It's just on an app on my phone. You get a receipt straight away. It's really easy. I'm a merchant. I'm a business person. I'm selling really easily around the world now. So if you want to buy the book, come and talk to me afterwards. But the real thing about PayPal, and this chart I love, is that if you look at their costs and their revenues, something really interesting is happening. And we're seeing this happening with Currency Cloud and others. That they start on this ramp up if they've got a good thing going, and these guys have got a good thing going. They're not changing the financial system. The payment mechanisms underneath are still the same. So like Apple, there's no fundamental disruption from these guys. What they're doing is they've added on a layer to remove the friction of payment on the internet and mobile. And then they really got their act together in 2011 because they launched an API for developers to integrate PayPal into the payment mechanisms anywhere of their services. And what you see happening is a sudden uplift in revenues and a sudden decrease in costs. The reason for the sudden uplift and decrease is because everyone else is doing the work. They've delegated the work of building PayPal into apps and services to the developers who like APIs. They did it again with mobile. When they launched their mobile API in June 2013, woof, up and down. That's what's important for processors. Lowest cost and good margin revenues. That's why PayPal this year is processing about $220 billion of transactions. Their revenue is about $8 billion, which makes them about the same size as Citigroup's global transaction services business. It's good business, but it's just an API. It's just a layer on top of the traditional financial system. Now, payments is a space that's really hot. It's where everyone's investing money. And again, it's referenced by Richard around the over 900 startups in the US receiving more money in 2014 than the whole of the investment in Y2K. Silicon Valley Bank, this is a chart from their presentations, show that there's been $10 billion invested in fintech startups in the last 5 years. And about a third of that is going into payments, because that's where people see a hot space. And what's also interesting is fintech itself is a new terminology, financial technology startups, fintech. I spend a lot of time at conferences now talking about the suits and the jeans coming together. The tech guys are the jeans, and they eat pizzas and drink beer, and the suits are the guys with Bordeaux claret and nice Michelin-star restaurants. Integrating these two is quite an interesting cultural clash. But it's happening. And it's not just happening here, but it's happening in a completely rethought world. People thinking really differently. You probably all know about M-Pesa. If you don't, then go and read up on it, because you should by now. Launched in 2007, it's taken over the Kenyan economy and it's moved to a lot of other areas. But what's interesting for me about M-Pesa is that not the success of that mobile payment mechanism, 80,000 agents looking after 35,000 merchants in Kenya to transact payments. But it's the thinking. It's changing the thinking. To us, mobile is just an evolution of the internet and what was before ATM and call center. It's just an additional channel layered on top of what we did before. For these guys, this is just saying it's transformational. We've suddenly got access to a network. We've suddenly got digital inclusion, which we didn't have before. Africa didn't have that. Indonesia didn't have that. And so now 40% of Kenya's GDP is transacted through mobile payments, through agents and P2P. And it's making people think differently. A goat herder in any African state, this guy's in Tunisia, can now become a salesman. He's got a Facebook page with lots of likes of his goats and sheep, which is quite worrying because a lot of them come from Wales. I said Wales purposely, by the way. But he's not just got a Facebook page with likes, he's loading up his pictures from Instagram saying, oh, I've just sheared this sheep, this wool is available for this price. And people can buy it. And he can take the payment on a text message. Everybody's a salesman, a merchant. So the real thing about mobile is it's changed us from a point of purchase to a point of sale. 7 billion points of sale for 7 billion people around the world. It's fantastic. It's the reason why Bill Gates at Sibos this year said that I believe everyone will be included in the network and we won't have poverty anymore. Not poverty in the sense that we know it, as in if everyone can sell, if everyone's included, if everyone's in the network and there's digital inclusion, then what we define as poverty in countries will not be meaningful by 2035, because there won't be any poor countries in the definition of the IMF and World Bank. That's because 40% of the Kenyan GDP is going through mobile networks. It's because everyone's included. It's because everyone can be a salesman, a merchant. So that's transformational, but that's a new system developing outside the old system. It's going to be nothing to do with banking. Although it is interesting that in Kenya, since M-Pesa launched, of the 18 million people that are using M-Pesa, which is about half of the adult, in fact, about half the population, it's an even higher proportion of the adult population, about 70%. 2.5 million bank accounts were being used in 2007. Over 10 million bank accounts are now open in Kenya, because 7.5 million people got a credit history that they didn't have before. So this is actually transformational in the banking system too. This is even more transformational. You probably recognize Bitcoin. Bitcoin spent a lot of time being a bit of a basket case, a Wild West, something that was all about money laundering, the Silk Road and drugs, and fake New Zealand dollars, if you wanted to buy them. It's not really about that. It's about transforming the financial system by creating money without banks. Programmable money. It started in this email from 2008 by Satoshi Nakamoto saying that I'm creating something that's going to have no trusted third party. Bearing in mind the platform, the code is the trusted third party, not the intermediary, as was. So when the white paper came out, one of the key things that it says is I want payments to be sent directly from one party to another without going through a financial institution. It's a key part. And creating a cryptocurrency that's trusted, secure, was revolutionary, and is revolutionary, because in particular, within this technology, and I see Bitcoin as a technology, not a currency, it's a protocol. Bitcoin, the protocol, the technology, is an open general ledger for secure financial transacting. The reason it's open general ledger is that you have a private key and a public key. The public key records the transaction. The private key keeps that transaction on the ledger until it's given up. As a result, you could replace SWIFT with Bitcoin. And that's what people are starting to talk about doing. That's the reason why SWIFT is actually being included in the blockchain developments, because they want to be part of the future. There's a company called Ripple that could easily replace SWIFT. Banks are all talking about what can we do with the blockchain. It's the technology. The blockchain is the open general ledger. This guy, Mark Andreessen, if you don't know him, he's a venture capitalist in Silicon Valley. He was the creator of Netscape. He now runs a $4.5 billion venture capital fund in California, and his mission in life is to destroy the financial system. That's what he's investing in doing, and that's why he's investing in this. He's openly stated it. Just to illustrate the blockchain further, it can be used for anything, not for a monetary transaction. It's a digital value exchange record. You could keep a value exchange of your marriage vows on the blockchain, and a couple have already done that. They got married in Disney World, very appropriate place to get married for this couple, I think, and they recorded their marriage transaction on the blockchain. They both hold private keys. They cannot divorce without giving up their private keys. I'll be interested to see what happens. Bitcoin is radical and transformational. It actually could destroy the financial system as was and build a new one, which is a digital value exchange system, which actually I think is the important thing here. It's a digital value exchange system for the digital age. It's not based around money and currency and cash as was. It's not based around paper, it's around digital. And the key thing here is that everything becomes person to person, point to point, machine to machine. Everything can transact with everything. There's no limits because the platform is what we trust. The old four-pillar model of cards is gone. It's just me to you. Direct. In code, we trust. So if we accept that that's quite radically different, then we can start to look at what does it mean for us, because there's all these insects, and I'm talking about a new business model. And you may wonder if part one has taken so long, parts 2 and 3 mean, Chris, you've got to finish soon. Parts 2 and 3 are really quick. Because once you accept you need a new business model, then you can start to move forward and think differently. So all these insects are around, and for these guys, they're wondering what to do. Because these new companies are really trying to destroy their business. And so what's the new business model? The new business model is that these guys are technology companies. They are financial systems integrators in this new fintech world where suits meets jeans. And so what that means from a strategic business model viewpoint is I want to look at all these new insects and see which ones are interesting and work with them, invest in them, build with them, integrate them. By way of example, SmartyPig is a social savings service that's launched in 2006 in the USA. It's the alternative to the lending market. So this is for saving, where I can publish on Facebook and Twitter or Instagram, on Snapchat, wherever I want to publish. I'm saving for a MacBook Pro. It's really expensive, $3,000. But I'm doing all these things like mowing lawns, doing a paper round. It's designed for younger people. It'd be interesting to see me doing a paper round again. And I'm 21% there. And you advertise that to your friends and family and say, help if you think I'm doing well. And they can contribute towards your goals. Now, a bit like Moven, referenced by Simon as well, you can just buy this as a white label service. So there's a direct SmartyPig social savings service in the USA. In India, it's called iWish. It's part of ICICI Bank. And they took the capabilities of SmartyPig and integrated them as a component into their bank structure, as a financial systems integrator of the best-of-breed components. I could spend a long time talking about ICICI Bank. They're one of the leading digital banks that I could talk about, but I don't have time. Funding Circle. What happens when small businesses grow? They become big businesses. So Santander is doing a joint venture with Funding Circle in the UK to say once your small business grows to be big enough that you need corporate commercial banking services, we're here for you. And we're recommended by Funding Circle to be your partner. So if we look at where we are today, we're in this world of financial systems integrators having to rethink their business models from distribution of paper in a localized network to distribution of data in a globalized network and being digital, technology at the core. And that is the new business model, technology at the core as a component-based financial model of systems integration of pieces. And then we start to think, well, what do we do then about our current systems because they're crap? Because most of the guys I deal with have built systems in the last century that cemented a channel structure into place. and it's not digital, and it's got a lot of legacy and heritage, depending on how you want to look at it, but it's not fit for purpose. But if we try and change it, it's changing engines at 39,000 feet, we're going to crash the bank. So how do we change from channel focus to access focus? And there is a fundamental difference. I'm really against omni-channel and multi-channel. I just don't like the word channel. To me, it's a bit like tape. That's what we did last decade. Last century. We don't do it now. By way of example, this is my slide from when I worked for NCR in 1996. Yeah, we were talking multi-channel integrator as our big new thing for our banks. And this was my slide, and I had a long presentation about all this stuff that talked about the future of mobile, which is based around these lovely pages and things. Channel is an old century, last century term. The current digital customer doesn't see channels, they just see life. And you can augment and enrich my life with the data you hold about me, where it's relevant, by giving me offers as I'm walking up to high street stores, by telling me more about my spending habits and how good or bad I am at spending or saving, whether I'm actually reaching towards my goals, whether I'm being stupid, whether I should think about a pension. Can I afford that house? You tell me, and augment my life with your knowledge. I don't go and find it through a channel. And this is my slide from 1997 of channels. What we had, and I know a lot of banks still have this, is a load of crap at the back that's called spaghetti or legacy or heritage. A load of stuff in the middle that made it look like it worked together, and a load of stuff at the front that made it look like it worked together in a way that was consistent, even though it wasn't. And then we had thousands of cracks in the technology that the customer can see because they go from call center to internet to branch and say, why is it you didn't know that I was in the online service last night looking at a mortgage? You should know that. And equally, all the hackers go, I can get in there really easily. You know, IBM say that the average bank gets 115 million cyber attacks a year, of which about 82 would bring down the bank. Well, it's really easy to bring down a bank if you've got so many cracks in this old legacy spaghetti structure. What you need is digital core, a digital core system for access, internally and externally, that's consistent and integrated across the institution. This gives you real-time knowledge about the customer across the single view, but equally gives you a real-time view of the cyber attacks. So you can shut them down as they happen, rather than after the batch overnight update. Someone said to me the other day, how do we do a digital core, Chris? Because you mention it so often, but you don't actually explain what that is. To me, a digital core is where you start to separate the processing from the content, where you get the data and you bring it into a single enterprise hub. And you leave all the processing where it is, but you started to then cleanse and organize your information, your content, in such a way that it becomes independent and can be then leveraged into the new processing engines. So rather than bringing down the flight at 39,000 feet, what you're doing is you're backing up the flight at 39,000 feet, and when it lands, replacing it with a new engine, with a new plane, with a new capability. The independence of content is the key thing here. That's a digital core to build an IP-enabled financial institution. Otherwise, you're just sticking lipstick on a pig, which just won't work. So the new architecture has to be re-architected to be access and digital enabled for the component-based financial systems integrator. And then you have the real clever bit, which is where the humans come in, because we're all human. And that's where you look at building the view of customer and the relationship with customer and the trust with customer. Customers are humans, staff are humans. The whole human thing is the most important thing. And we lost the human thing because we built these silos in the last century, where we were pushing products to customers through channels, and that's the reason why a lot of people still think that way, rather than building access through communities to our services. This product silo thinking came from McKinsey. You always have to blame McKinsey for something in the presentation. It's actually 1960, Citibank had a challenge with their corporate customers who were going global and said, can you sort this out? Because our corporate customers are saying that Mary or John in San Francisco or New York doesn't really understand their business well as they're going overseas, because they just have a relationship in New York or San Francisco with us. We need people really understand FX and cash pooling and netting and forecasting and supply chain and working capital. So Citi gave that problem to McKinsey. McKinsey came back and said, you need to organize, rather than having Mary or John in San Francisco or New York being the relationship, you need to have product people who really understand FX, netting, pooling, cash flow, forecasting, and trade finance. So they reorganized all of their corporate operations around products, and as a result, had huge success with their corporate customers. So they did the same in retail. And as a result, JP Morgan, Bank of America, and the other banks copied the model because they thought that was the right business model for their organizations. And we now know that's flawed because we don't have the ability to cross our chasms of silos of business owners. But we're going to have to do that because if you're going to build relationships, at the moment, all we really have as a relationship is the trust that we won't screw up the money because we have a banking license. That's the real trust. It's not in our brands. It might be different here in New Zealand, but in Australia, I always remember St. George Bank saying that their bank brands were about as popular as cat litter because they had a survey to prove it. In the States, there was a survey last year of 10,000 millennials, people under 35, and the top 10 most hated brands included the top 4 banks, Bank of America, Wells Fargo, Citi, and JP Morgan Chase. The trust is not there in the brand, it's in the license. And we all want to build relationships and say that we're relationship institutions. But we don't get there unless we're really acting in the interests of the humans that we deal with first and not in the shareholders. So the real relationship as well is no longer in the place it was. It's now screen to screen. It's not face to face. Screen to screen, digital relationships is where we build trust in the new world. In the old world, it was through our license. And to build trust in the new world, the relationships are actually in the network, the social network. That's where people are getting their main influences. And the best bank that really gets this, and I think this is a great example of the next generation digital financial institution, is a new bank. But it's a proper bank with a banking license called Fidor Bank in Germany. It's a pucker bank, it's a real bank. But they launched in 2009 and wanted to appeal to the new generation of customers who were disaffected by the financial crisis, the ones who were in the Occupy movement and the ones who felt the system has to change. And they're doing quite well, but they're doing really well in terms of how they market themselves. And this is how they market themselves, on Facebook. And their interest rates are set by the number of likes they get on Facebook. So this is their loans. Their loan rate is 6.9% at 18,000 likes on Facebook. When they get to 20,000 likes on Facebook, it goes down to 6.8%. 22,000, it goes down to 6.7%. They got over 21,000 likes today. It's gone down to 6.8%. It resets every year. But the reason they do this is particularly because they know it works. Because the average person on Facebook's got 338 friends, according to Pew Internet Research. So every time they get 2,000 likes, they've got 625,000 plus advertisers of Fidor Bank to friends and family. And they then build community. They build discussions. They build conversations. They build relevance. They build the fact that they and their friends liked the reduction in interest rates on loans and the increase in interest rates on savings based on likes. So here's the real bottom line for the new building the world with the human interface, is you've got the digital core, the digital architecture, the digital business model of component-based finance, and then you build friends and relationships through the network. These guys do it by being social with their network, informative and fun. And the average cost to acquire a registered customer on Fidor Bank is 1.33 euros, which is just over $2, New Zealand dollars. The average cost to gain a full KYC process customer, 16.7 euros. A full know your client, fact-find registered customer. The average American bank spends $1,500 pushing products through channels and using old media and old values to get a customer. 1,500 US dollars. These guys spend 16 euros, about 30 New Zealand dollars, to get a customer. That's the difference, because they're being relevant in relationships rather than pushing products through channels. So I've spoken for quite a long time, but that's the thesis of where I come from in terms of the new world of digital finance. It's a very different world of digital distribution of data in a globalized network to the old world. And then if you want to know how to do this, and I think some of you already are, just read the book. Thank you.
Fascinating. A book condensed into 30-odd minutes. Some questions from the floor for Chris. There must be some. Oh, over here.
Need the lights changing.
Chris has a great presentation, thank you. A lot of today and a lot of what we talked about is B2C. You touched on some B2B in your environment of a digital bank there. How do you see B2B banking or B2B finance in a digital age panning out?
Yeah, I recently went to a cash and treasury conference where I was moderating a panel of 3 large transaction banks, and they got very upset with my blog afterwards because I said they were talking BS, which is not a very diplomatic thing to do. But the reason I said that is that it came up during the panel, and they said technology has not changed the corporate to bank relationship at all. The corporate to bank relationship is all based around subject matter expertise and intellectual property and all the history of the relationship of knowledge about that at corporate. And technology is not impacting or changing that one jot. They all said that. And I just thought, what a load of BS, because that's not the case. I mean, I mentioned Currency Cloud, TraxPay, TransferWise, Color Coins, a Bitcoin-based system for registering share sales and IPOs. There's a lot of things happening with the insects to change the corporate to bank relationship. And some corporates are waking up to it. I don't think many are, partly because it would be very difficult. In the same way as it's difficult to change a bank's organizational structure to be digital, it's just as difficult for the corporate to do that, for many corporates. So maybe they are a little bit hamstrung by their heritage in that relationship. But it's not that they're not thinking or looking for technology to change that. The best example of one company that's changed B2C is I spoke at the same conference in 2009, but this time it was in Asia and Hong Kong. And I said that you'll all be using apps and iPads for cash netting and pooling and FX and working capital within the next 18 months. And they all laughed because the iPad had then just come out and the idea of using apps in corporate treasury was like ridiculous. And then they all were 18 months later. But one of the banks has done a really cool thing with this, which is Deutsche Bank. And they've broken down all of their capabilities in corporate treasury operations support into components, going back to the component-based finance model. They've now got over 200 component-based apps for treasury operations that the corporate can configure into the way they want their dashboard of services to be used. And they can also allocate them to different employees on different bases. So you might say, for this staff, we're going to give them capability to do netting and pooling. For these guys, they can actually do FX transactions. And the different integration of the model of the Autobahn app store gives the different staff the different views of those apps. But it's all about thinking, how can I break this down to its lowest common denominators and then offer that as my product-based, cloud-based services to my customers that they receive through apps. That's the bit that's changing everywhere. And I was recently at a dinner where, again, a bunch of bankers were talking about things and saying the reason we have to change is that our corporates are demanding we change because their customers are demanding that they change. So technology is fundamentally disrupting and changing the corporate space just as much as the retail space. And for the financial institutions that think it doesn't because of IP and subject matter expertise, I think they've got their head stuck in the sand.
Other questions for Chris?
Everyone's too scared. No.
Chris, fascinating presentations, particularly the peer-to-peer lending piece. What are your thoughts around the regulatory implications for peer-to-peer as that grows?
Yeah, the regulatory thing gets interesting. And I'm having regular arguments with the Bitcoin community about the regulatory piece. And the reason is that the Bitcoin guys talk about money without banks, but also money without government. And my claim is that money is only existing for governments to control our societies. That's the reason it was invented, for control over people. And so if you suddenly take away the control piece from money, then the whole thing falls apart. So Bitcoin will not work without governmental regulatory influence. And the Bitcoin guys hate it when I say that, but it's going to happen. And what's actually happening is the banks are starting to incorporate the Bitcoin blockchain into what they do, so that if you want a trusted transaction that's got a guarantee, then you go to the blockchain from the bank. In fact, my best illustration of this, do any of you remember Second Life? It was a virtual game, but it was also a virtual economy. And it's created by Linden Labs in 2004. It became hugely popular in 2007, mainly because people were making a lot of money out of it, and it got a lot of media coverage, and a lot of banks went in there. So BNP Paribas were doing job interviews through virtual cartoons in Second Life before people came into the office in real life. ING created a whole virtual Holland in Second Life, which I thought was quite interesting because they included pornography and everything else that's in Amsterdam, which is quite interesting for a bank. But what then happened is that Second Life imploded, and the reason that some of you may not remember it is that it disappeared pretty much. I mean, it's still used by a small number of people, but it's about 10% of those that were using it in 2007. And the reason it disappeared is because George W. Bush, in his infinite wisdom, outlawed online gambling on US domestic soil. And so all the casinos moved to Costa Rica and other places. And Linden Labs felt that they shouldn't actually allow gambling in virtual dollars on their virtual economy because they might get caught in the regulations. So they banned gambling in Second Life, not realizing there was a lot of people gambling in Second Life. So $1 US dollar equaled 275 Linden virtual dollars. And what happened when they outlawed gambling is that there was a run on the virtual banks in Second Life. And the biggest virtual bank in Second Life was Ginkgo Bank. And Ginkgo Bank, about 24 hours after this new ruling came in from Linden Labs saying no more gambling in Second Life, disappeared. You go to the virtual ATM and find there's virtually no money there because it's no bank there. And the customers didn't like this very much of the bank. So they wondered what had happened. And they asked Linden Labs, and Linden Labs said, nothing to do with us. It's up to you. The guys didn't like that answer very much, so they had a virtual demonstration outside the virtual Linden Labs offices. And it lasted for 3 months, until eventually Linden Labs turned around and said, you know what, to be a bank in Second Life, you've got to be a bank in real life. Because Ginkgo Bank turned out to be run by a 32-year-old student in Sao Paulo, Brazil, who had $1.5 million US dollars on deposits that were worth over $300 million in Linden Labs money. And because he took the normal attitude of a banker, he spent half of it on other stuff, thinking that he wouldn't need to pay people back suddenly or quickly. And he bought a condominium and a Ferrari. And that's the reason why you need to have a regulated economy, wherever you sit in P2P or Bitcoin or wherever, because if you don't have trust in the system, then the system fails.
Any further questions for Chris? Yes, down the back.
I don't know if that's on. Good morning, Chris. I heard from the Reserve Bank yesterday about how much they love cash, and in fact, the first slide they put up was about the brand was impinged on printing coins. Totally get you about why governments love coins and cash because it gives them control. Given the Mt. Gox blow-up, which demonstrates some of the problems with Bitcoin from a control and trust perspective, and given the fact that governments want to control power and all of those things through cash, what's your recommendation and view of the governments and the industry and the financial services organisations that will get this digital currency, and how do you see that then kind of landing kind of 12, 24 months out?
Yeah, I mean, we've got a fundamental challenge, but eventually we work out the challenge. So I think where we are with money right now is where we were with music in the late 1990s. We have Gawker and Pirate Bay and lots of other sites offering free music, which is illegal. But how do you regulate something that's illegal when it's digital? Well, what you end up doing is, first of all, you need to create a better way to do it, which is iTunes. And then you need to create a mentality that says it's wrong to do it, which is all the advertising you see about pirating films and all the other stuff that goes on at the moment. But you're still going to have a core community that's going to use the free system because it's free. But of that group that uses the free system because it's free, how much of that group is using it for illegal purposes versus just because they don't have any money and they don't want to pay for downloads? So then you get into the dark net and dark torrents and shadow internet and what's going on there. And I think really we're just seeing this evolution of thinking around governmental controls, saying how do we keep up with the revolution that's taking place through the technology. And bearing in mind that regulators are always coming from behind, they're never in front of the system. It's just building step by step the pieces to keep up. A little bit like the cyber attacks on banks. You don't know who's going to have the next capability to crack the bank. You know someone's always going to try. You just try to make sure that you're always keeping up with the latest capabilities to block and defend yourself. Right now, that's being in real time across the whole enterprise, for my opinion, with the digital core, as I said. But I think the Bitcoin thing is quite interesting. And when Mt. Gox disappeared, I got very annoyed because I had quite a bit of money in Mt. Gox. Having said that, it was virtual money. I haven't put much real money in, but thanks to the inflation in the price of Bitcoins, I was thinking, hey, I might go and have a nice holiday this year. And then it all disappeared because Mt. Gox disappeared. And I deal with a lot of people in the Bitcoin community, and one of the key people is on the Bitcoin Foundation. I said, how come no one knew about Mt. Gox? He said, oh, we've all known about that for years. I said, well, I lost a lot of money. He said, oh, you've been goxed. I was kind of like, quite annoyed. And so then I said, well, what should I do? He said, well, there's plenty of places where you can put trust in using Bitcoins. Like there's a brand new company called Circle. And it's a full, easy-to-use banking service for Bitcoins. There's a cryptocurrency bank that's just been launched in Europe that's a full bank-backed cryptocurrency Bitcoin exchange that can be trusted because it's licensed and regulated. That's where all these things eventually evolve to, because you can't have thousands of dollars, millions of dollars disappearing and no payback. There's always going to be a payback.
Other questions for Chris? I was just wondering, when we had some questions there about Bitcoin and peer-to-peer lending, whether you think that the traditional banks, with a comment like yours, alternative finance is becoming the norm, whether the traditional banks are worried enough about the threat presented by the likes of peer-to-peer and crowdfunding and the like? Yeah,
I mean, one of the things that comes up consistently, and Brett's very good at saying this, is that banks are all doomed and you're all too slow to change and you're all rubbish, even though we're partnering with Westpac. And I say banks are not doomed and they're not all rubbish. They're very intelligent organizations that see all this happening and are waiting for when it's right and ripe to change. And what's interesting right now is a lot of the institutions that I've always thought of as being pretty traditional and rubbish and slow to change are becoming far more adept and faster at change. Two examples, Lloyds Banking Group in the UK, you probably didn't see it, they just announced that they're closing 200 branches and getting rid of 9,000 staff. And as usual, the media said, oh, Lloyds broken the trust of customers, saying they'd be the last branch in town. But underneath the announcement, it said, because we're investing £1 billion into digital services over the next 3 years, because customers are moving themselves to these services. Barclays announced figures recently saying that their average customers use their app 26 times a month, but they go to a branch once or twice a month, if that. BBVA said that 95% of customer interaction will be digital, only 5% is going to be physical by 2017, which in Spain is phenomenal because the Spanish are very much into a branch-based culture as a country. But they're closing down branches very quickly. We've seen 8% of the European bank branch network closed in the last 7 years. But the most telling piece about BBVA is that they're offering their customer data to developers and through APIs. And the customer data goes out there normalized, and it's completely anonymous. So you can't track who was spending what where. But they just want to see what ideas they get. So they run an annual competition. And what they get back is really interesting stuff because they're moving to digital. So the app that won the award last year, I really liked it. They took all the customer data around where people were spending with merchants around Barcelona and Madrid, which is the information that was given out, and came back with, on the footfall traffic of customer spending, we can tell you where the busiest places are in real time. So when you're a tourist in Barcelona or Madrid, and you want to know, should I go to the museum at 10:30 or to the shopping mall at 10:30 or down to the Café d'Art at 10:30, they'll tell you which one's empty. Which is quite useful because they'll also say, and don't go here until 3 o'clock because it's really busy right now. And that's real-time analysis of payments and transactions that's providing that capability. And as you get to information enrichment and digital enrichment of the customer knowledge base, and the customers flock towards that, again, you heard Simon say, 70% of their customers are mainly internet banking online users, and of those, 40% are mobile first. You don't need to have the old physical network. You end up with a branch-based network, but about a tenth of what it was. Deutsche Bank say we need about 500 bank branches for all the biggest banks in the UK. Right now, Lloyds is 2,250, RBS is 2,000. We're going to see 5,000 branches closed over the next 10 years, not at any loss of service.
So they'll still be there, but just a slimmed down version of their former selves.
And then we'll have the screamers that say, what about the old people who can't get out of their home? They'll just have to be
get the old
served
people online.
another way.
Some fascinating insights from Chris. If we haven't got any final sessions, we'll say thank you to him, but don't worry, you can hear more from Chris. He's going to be joining our final panel of the day, so he's got plenty more to say, I'm sure. So do stick around for that panel. Thank you, Chris Skinner.